Good afternoon and welcome to the Personal Group Holdings PLC Results Investor Presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paula Constant, CEO. Good afternoon.
Thank you very much, Alessandro. Welcome everybody to a beautiful, sunny, almost 25-degree September day, which we thought very relevant to reflect the results that we are sharing today. We're super happy with our half-year results and remain firmly on track to deliver the rest of the year. For anyone that hasn't met us before, I'm Paula, the Chief Exec. I've been at Personal Group for 2 years. Sarah, the CFO, has been there considerably longer. I think we're on 12 years. And, we've got a fantastic team behind us delivering really good results for the business. But I think more importantly, delivering really brilliant products for our customers that remain, more important as the economy worsens and, the lack of sick pay provision and benefits in general become more important to employees in the UK. So I think without kind of further ado, we will take you through a little bit about the company for anyone that doesn't know us. I'm probably assuming, most people do, but I'll go back to basics very quickly. The progress to date against our strategy, and particularly what we've done in the half year. Sarah will canter through any of the other numbers that I haven't stolen her thunder on. And I'll just finish up with a few points about, what to expect from us in terms of focus for the second half of the year, and what we're thinking about kind of pressing into the first full year of our 5-year strategy, which starts next year. Okay, so moving forward. We exist at Personal Group to help businesses positively impact employees' happiness, health and protection, which is just a wonderful thing to be able to do. We now go to market with 2 main divisions, insurance and benefits and rewards. For those of you that have been on the journey with us last year, we spent a lot of time simplifying, consolidating into 2 very, very clear units, selling off our technology salary sacrifice business, putting our our consulting business into 1 unit, which now goes to market under the Inecto banner. So it's been great really entering this year with that level of simplicity, both from a market message but also from an organizational perspective. Insurance, which is our heartland, is what the company was founded doing, and really the benefits and other areas have grown up around that to support a much more holistic proposition to employers and their employees. Really focuses on selling 3 key plans. So we have a hospital recovery and a death cash plan. We do go to market predominantly through face-to-face engagement. So we're on our client sites talking to employees about a range of benefits that are important to the client and therefore the employee, and then talking about the insurance policies that are available. So it's mainly an employee paid, kind of cash plan proposition delivered for face-to-face, although we do have a now growing and prominent group cash plan that is bought at the employer level. And then on the benefits and reward side, we've got our own proprietary tech benefit platform, Happy. So Happy is the brand for our direct clients. We've got about 200 plus direct clients on the platform, some of which also take our insurance propositions as well, some of which are Happy only. And then our main route to market, as we've outlined in our strategy, is the growth through the partnership. So we white label our product. Biggest predominant partnership is the partnership we've had over many years with Sage, which we were delighted to kind of announce a re-sign of that contract earlier in the year. That takes us to at least 3 years, and then onwards to 5 years of continued growth with Sage, which is fantastic. But we're also onboarding other new partners in that space as well. And then finally, the consulting division, Inecto, which we We're proud to market as the UK's largest independent pay and reward consultancy, as well as having that independence of data, that informs a lot of the work we do. We've also got some fantastic digital tools in play there, which would, probably be about a third of the revenue that we make now. Doing everything from job evaluation, pay and reward benchmarking, and we've got some exciting additions to that toolkit going out to market later this year. So that's our business in a nutshell. And then moving on, we think there are many reasons that our customers love us. Our big USP in the marketplace really is that we are the only employee benefit provider that can really go face to face and deliver the messages about all things that are important to the client in terms of employee benefit. Sometimes we're doing that using our benefit platform. Sometimes we're demonstrating, other benefits and other benefit platforms, and then obviously moving on to talk about insurance. But that face-to-face engagement remains really critical, and is a proven method of driving up engagement of benefits platforms, over and above any examples we might have of not having face-to-face. So, that's really such an important remaining differentiator for us. We continue to convert brilliantly on our insurance products. So having an insurance product that converts 50% of the time that we're talking about it, I think is testament to the real relevance of the product, as well as, the team that stands behind talking about it. It's simple, it's transparent, it's easy to understand, and it really delivers material results for people that really, really need the support and may not get that support from a wider PMI or group cash plan provision from their employer, and certainly couldn't afford anything more expensive, that might be bought on the high street. We're very proud of the technology. Those of you, again, that have been with us on the journey of Happy know that we spent a considerable amount of time last year just finishing off our migration from 2 different instances of platform onto one. That's helped us achieve some really good cost savings in the run costs going forward, but also helped us rebuild the platform in a super modular way that helps us scale for partners and direct customers. So very proud of the efforts there, and it's been great to start this year with just the small problems of decommissioning the old platform and really just finishing off anything we need to do to now kick into any future demand. So really pleased to kind of be through that period and into this year. And then I've already talked about the great benefits of the consulting business, which has really had an absolutely fantastic first half of the year, probably one of the best half years that the consulting practice has enjoyed for some time. We continue to win great awards. We're equally, proud of the awards on consumer duty, on customer service and claims, as we are on all of the recognition for technology. So I think, the awards demonstrate the real breadth of what we offer across the portfolio and the many dimensions on which we perform. We've talked quite a lot in these investor presentations in the past about the market demand and the relevance of our products in an economy where the cost of living crisis still prevails, where businesses are under pressure now from the government, with potentially depleted HR budgets for things like even low-cost PMI and other provisions of insurance. So, we feel this does really create the perfect kind of storm for, for our products and services in the marketplace. More and more, I think we're now hearing that, as well as employee benefits being so critical to stickiness in companies, for people wanting to come and particularly for people wanting to stay, the real elements of those that matter at the moment are any that protect people financially. So people that need salary advance, people that need salary loans, people that are looking for any kind of saving to make life easier. We're certainly seeing that more people are missing bill payments, more people are taking up health cash plan provision, which is great for us. And businesses are certainly saying to us that PMI, even low-cost PMI, is a more expensive option, for them to contemplate at the moment when they may have been looking at it before. So, all of these aspects are things that we can solve with our products and portfolio, which make us probably more relevant than we've ever been. And of course, on the consulting side, there's increasing need every year to comply with pay transparency, EU pay transparency, gender pay transparency, which makes the products and services in Necto a must-have, rather than a consideration. Again, more important for us, more important than ever. Okay, so moving on, a great half year, as I hope our results in the RNS have shown. Up on revenue, up particularly on insurance sales, which is such an impressive increase given the kind of huge target that we had last year. Up again on ARR across all elements, really strong EBITDA, and Sarah can talk a bit more about the thinking that we've done around the dividend policy, and hopefully our shareholders are very happy with the interim dividend payout, which we've of course been able to do, maintaining a pretty consistent level of cash, such as the continual generation of the cash in the business. So I've probably stolen everything Sarah's going to say in the financial section now. Okay, and then just finally, I've got a couple of slides on the three big areas of progress this year, but just a reminder for anyone on our strategy. So this time last year, we set out our 5-year strategy, and really, kind of the end year goal of 2030 of tripling our EBITDA rate from the exit rate of last year, the 10 million, being in excess of 100 million revenue, and really kicking on with a sizable increase on the SaaS ARR. And it was great to hear that the feedback was ambitious but achievable. We of course plan to do all of this organically. We would be slightly naive really to plan in any unfactored inorganic growth, and anything that we might do down the line would just be in a position to accelerate this. But we are fully focused on an organic plan to get here. The main premise of the strategy is around continuing to penetrate the base in insurance, and continuing to get better at what we're doing, and boarding more customers in the existing base of clients that we've got, but of course winning a lot of new insurance clients. And one of the key parts of the strategy is that access to 300,000 new employees over the course of the 5 years. We'd also like to be able to deliver 10% of EBITDA from new insurance products and channels, and that includes the digital variant of what we do in face-to-face. And then on the benefit side, it's largely around partnerships. It's about exploiting the fantastic opportunity that we've got with the new Sage contract, and getting new segments up and running as quickly as we can, and then also onboarding some smaller partnerships, so that we've got some other proof points and some different types of segments and communities reached, as well as the great opportunity that we have through Sage. So that's the strategy, and I can talk a bit more about the real focus that we've got in the second half of this year to accelerate into that strategy, given that we've got great confidence in the rest of the year ahead. Okay, so the first of the three is insurance, and as I've said, to achieve a 6% increase on the 18% last year is really as phenomenal in itself as the 18% of last year. We set out a really diligent, stringent approach to insurance at the beginning of last year. I brought on a super trusted COO in how we'd worked together for many years on really kind of best in class operations, and obviously we're fortunate to pick up such a brilliant, motivated and capable team to work with. We did a lot of work last year on the forensics of the operation, both from a volume and value perspective. There's always more to go at, and I think we've proved that out this year. Insurance sales up 6%, enrollments up, nicely up year on year. But as critically, the value of what we're signing up is also up nearly 5%. And on top of that volume value progress, we're also holding, brilliant performance on early cancellation rates. So last year I challenged the team, very hard to reduce that rate, which came down by 10%, and it was always a very competitive rate to begin with. I've not seen a cancellation rate anywhere that kind of started at the point it was last year, but to get that down 10% and to continue to move that from just over 13% to just under 12% now is really great. Our cancellation period is over the course of a month, so it's probably almost double some of the cancellation rate periods that you might be used to in other walks of life. So I'm really happy with the progress on that, and that's just a really good example of not just the relevance of what we sell, but how sticky the products actually are. We talked a lot about the penetration rate. So, we want to get more of our base of employees and the clients that we serve signed up to our policies. When we first looked at the data, we were only 12% penetrated in our clients. I think that's a huge opportunity for us. There are lots of different ways for us to unlock that, but clearly, where we visit, how we visit, what we talk about, how effective we are on site is the key thing that Howell and the team drive. We were forensically focused from the end of last year on the top 100 sites. So this isn't top 100 customers. It's the biggest sites we have, many sites across some of our top customers, for example, with the most people. So obviously, if we move the dial on that number, we've moved the dial overall. And I'm really proud that the team have focused so diligently on that and moved that number up itself by about 4 percentage points, which has driven the overall penetration from 13% at the end of last year to 13.7. So last year went from 12 to 13. Now we're well on the way to doing another percentage point of penetration. And I think that the team have really worked their magic on all of the opportunities there. But there's always much more to do. And, we know that some of those sites in the top 100 are, reaching 20% plus levels. So we know there's more ground to go at for sure. And of course, against that backdrop again, and I've mentioned the early cancellations, we've got a very high Trustpilot score. To challenge many people not anybody to find a better Trustpilot score in the insurance landscape. We're very proud of the service that we're delivering there. Our claims, 98% processed in 48 hours is fantastic. And then our retention rate of the book overall on insurance is 82%. So, that number has been pretty steady over a number of years, but probably has crept up from high 70%, over 80%, and continues to move up as well. So, so really fantastic progress. And then, of course, we are very focused on winning new business. So the first full year of our 5-year strategy kicks in next year. We wanted to enter that year with the first tranche of customers of that holy grail of 300,000 new employees that would be addressable for insurance that we want to reach. And the team, worked particularly hard. This is our B2B sales team, but they've also worked very hard with the insurance team to identify and track down good opportunities. So we now have line of sight to at least 25,000 new employees through new client wins, which is fantastic. And just to give you an idea of this, that number is much bigger than that. And then, we take a realistic view of, in those new client wins or any client win, what would the addressable employees be there? Are there employees in areas that we might not visit? That there'll be some sprinkling of management, etc. in there. So this feels like a really good, realistic number from a much bigger number of employees that we've won with new client wins. So there's a level of confidence now that we can get to our own internal target of about 40,000 into next year, which gives us a great opportunity to start widening that net. And of course, the other routes to doing that versus winning customers directly partnerships. We announced earlier in the year that we had won a tender. We've now signed the contract on the back of the tender with an employee benefit provider, competitor of ours, to be their insurance arm, and we'll do a range of things with them. But the big opportunity for us is obviously face-to-face. We'll do a digital variant of what we do face-to-face, and we'll also offer a group cash plan. So, that's a huge opportunity for us with a employee benefit provider competitor that is, probably has about 3 to 4 times the addressable base that we would have, for example. So, on paper, we've got a huge opportunity for new client growth, but we're not resting easy on any partnerships delivering. We're still trying to win customers direct as well, because obviously the new wins insurance are really, really important. I'm trying to read the questions in parallel too, because I've just seen one pop in on insurance, and I like to weave the answers into what I'm talking about. So I think there's a really good question. How scalable is the insurance distribution model in terms of cost to acquire new clients? Are we seeing declining acquisition costs? Expansion require step up investment? So the quick answer to some of that is, we have a small team, about 50 employees in the insurance division that go out and meet face to face. We have planned in our 5-year strategy that would go up to about 70. So it's not a huge increase, and we'd start, bringing new employees in, as we've got line of sight to probably needing to backfill existing clients. We'd send our existing experienced people out to new sites. So that's our plan. So we're not, that those costs have been factored into our 5-year trajectory. In the field force, I think that partially answers that question. And let me come back and see if there's any other elements to that question that I haven't answered when Sarah's doing her finance bits. I can answer that again at the end. So yes, the costs are factored in. Yes, there's a huge opportunity to acquire more customers. I think when we shared some of the analysis, it's probably 18 months ago, the customers that we had were also only about 12% of the total market opportunity. So, there are clearly lots of potential clients out there that would be brilliant for our products and services that certainly aren't served through a face-to-face model today. And I think, we can see the starting of winning some of those with the line of sight to the 25,000 new employees. Okay, I'm proving I'm really not very good at reading and talking at the same time. So I'll definitely have to come back and answer a few more questions in a bit. So the second part is the digital insurance, and I think we've been clear that the face-to-face model is our USP and a real differentiator, but there's certainly an opportunity out there to reach more employees that we can't reach with face-to-face through digital. Part of providing the insurance partnership for our employee benefit competitor is obviously the digital variant of the proposition that we've got face to face. So we've spun that up. That's kind of ready to go. And we thought we'd test that out in 11 of our existing clients that are on our benefits platform, but don't take face to face, probably because they're, not quite the right size, or they're geographically dispersed and they wouldn't quite be right for a face to face model. So the results have been really positive. We've had, end customers, so employees buying our product, buying multiple products, buying more than one policy of a product type, for other members in their family. So probably all of the little scenarios and situations that we want to test out have been tested and worked. And of course, everyone that's gone on the buying journey has gone all the way through and bought. So clearly, we've proven that we've got the right information, message is clear to understand, the buying journey is great, it looks and feels great. So the question for us to continue to test is, what's the art of the possible? Because it's a very different model to the really engaging way that someone will sit and talk with an employee in a dedicated period of time for 20 to 30 minutes about everything, benefits, but also the insurance policies, versus communicating something on a benefits platform that someone might trawl through in their everyday life. So the obvious points about what's the art of the possible in a digital insurance take up world, which is not quite comparable to a direct to consumer either, because we're selling through businesses, through the employee benefits portal. But very happy with the progress to date, and more to do to test out. In parallel, the group cash plan offering, which, as well as going to market through this partnership, we'll be taking direct to clients, and we'll be testing out through other channels through the course of the next half year and beyond. This was an important play for us, really, because the upside to the cash plan is the opportunity to sell our employee paid cash plans, either face to face or digitally. So in itself, it's not going to deliver the same kind of value that we will get from our own plans, but it's an important addition, both from kind of increasing our reach, but also a defensive play as well. So very happy that we've got that up and running in terms of design. Looking forward to launching that and testing the feedback on that. And then finally, we've signed another insurance partnership with Sonte, who themselves provide a great range of insurance products. So that there's a couple of insurance partnerships plays, as well as the direct approach that we can take. So all things tracking in the right direction for us in terms of digital, although clearly our big focus for the years ahead in the strategy is landing new business that we can service face to face. And I definitely can't read any questions on that in parallel, so I will come back to any on that. Then finally, I think before I hand over to Sarah, the third strand is obviously the benefits division. So strong performance on all fronts on benefits. We have launched our first new segment with Sage, which is Sage Ireland. So it's a parallel segment to the UK that's delivered in Ireland. I'm so impressed with the teams on both sides that really, from the point of signing contract, we got that up and running in probably less than 2 months. The results have been really strong. And you would expect that in the first couple of months of a campaign, when it's something new for the Sage team to sell, but they've been far stronger than even that initial first trajectory. So we'll see how that plays out over the next course of the few months. And then the key for us for the rest of the year is which segments can we work with next with Sage. And our preference is certainly to see what we can exhaust in the UK market before we press more heavily into overseas opportunities. So that there's considerable potential there, to deliver a lot of the number for the 5 years through the Sage partnership. But of course, we've got other partnerships in the pipeline, and we announced, I think, at the full year for last year that we just signed a partnership with EB Now. We've got a couple of initial customers live, and the final delivery of the partner capability will be released out to EB Now to sell, with anger as we progress into kind of October, November. So we're excited to see how that ramp up plays out, and that will really give us a good marker to understand how many more smaller partnerships we need to onboard, whilst continuing to prioritise the opportunity with Sage. And then on Enecto, again, I've mentioned the strong performance. We have a great new tool, the Pathfinder tool, which is a good way to digitally understand how you advance your career, the steps you might want to take, the skills that you would therefore need to invest in. We've got our advisory board for Enecto fully launched. We had the first session of that a few weeks ago. Again, strong, consistent client demand, and probably even more we can do on that and in reaching out to new business, because there's a lot to service really from the existing kind of client base and onward opportunities. So still much more to go at Enecto, and very pleased with the performance of the team in the first half. Right, I will hand over to Sarah for a bit more detail on the finances.
Thank you, Paula. Afternoon, everybody. So in terms of the overall numbers, I mean, obviously a really strong H1 performance for us. Revenue growth of 11%, up to 23.3 million, and that was reflective of growth across all areas of the business. And that translated to a 42% increase in EBITDA to 5.5 million. With those results, obviously, we retain our strong balance sheet, remain highly cash generative, 4 million of cash from operating activities in the first half, and cash and deposits at the end of June of just under 27 million, with no debt. We also announced an interim dividend of 8.2p with these results, up 26% year on year, but perhaps more importantly, also announced a change to our dividend policy. We're currently in growth mode, and we wanted to sort of reward shareholders along the journey of us delivering our strategy. Those of you who've been with us for a while will know that we've always been a company that's paid out a fairly significant proportion of our post-tax profits in dividends, so around the 80-85% mark. But from 2025 onwards, we're changing our policy and expect to pay dividends of around 1 times EPS for the full year over the period of the strategy, so broadly 100% payout. I also saw one of the questions in there around what does that mean for dividend versus EBITDA along the way. I mean, obviously we can't control tax rates, and there will hopefully be some element of dilution from LTIPs along the way, but effectively we would expect it to broadly be in line with our EBITDA growth along the 5-year period. Just in terms of looking at the strategy, I think we as a board, we debated the dividend policy, but we do believe that this policy enables us to give that return to shareholders, but with obviously our strong balance sheet, still to have plenty of opportunity to invest organically or inorganically should we want to along the way. So just looking at the segmental analysis and the different contributions, so broadly in terms of EBITDA, roughly 70%, 30% split between insurance and benefits. Obviously, other there is the interest that we get on the cash balances, so benefited in year from having that higher cash balance in play. And we kept our group admin and central costs, maintain those around 2% increase year on year. But probably the piece on this slide is the pink box in the left-hand table, which is just highlighting the increase in our recurring revenue streams. So in terms of insurance, the policies are on weekly or monthly rolling policies, so essentially act as in a similar way to a SaaS model. And obviously the benefits and reward is that SaaS income that we get from either Happy Seb or the Enecto products. But overall, a 12% increase in those recurring revenues, which obviously gives us really good visibility, certainly in the second half of the year and into 2026 as well. Moving on to insurance in a bit more detail. Paul has already spoken about the record new insurance sales, so 7.4 million of new business written in the first half of the year. And the retention rates up slightly also year on year at 82.2%. The way the policies work is that we collect premiums via payroll, so the client employer will deduct those premiums and pay them over to us. Again, there was a question around retention and what happens when employees leave the business. So probably 5 or 6 years ago, at the point somebody left, that policy would have dropped off the book almost immediately. We would have perhaps written out to ask people to continue, but with very minimal take up. Probably since the last 5 or 6 years, as we write new business, as well as getting payroll details, we also collect direct debit details as backup for when those individuals leave their employer. And as a result, when they drop off payroll, we do have that alternative payment method that we can flip them over to. At the moment, I think in the first half of the year, we probably had around 1.3 million of that insurance revenue coming from those flip policies that we would previously just have lost. And at the moment, we have around 60 to 65% of our current book where we've now got those alternative details in place. So as a result of the retention rates and new business, obviously we were able to grow the book to 38 million at the end of June. Just a little bit on the claims ratio, so down a few percentage points on the same period last year. Broadly comparable across all the products. We just saw a slight drop coming into play there. For any of you that have been around for a while, probably our claims ratios used to sit around the 24-25% mark. But certainly since last few years, Consumer Duty and focus on fair value, it's something we're trying to price our premiums, so we're ending up somewhere probably around the 30% mark, which we're comfortable when we look at in terms of fair value as well. And then in terms of overall EBITDA contribution, 25% increase in EBITDA, and that was alongside obviously increasing the number of field days, so by 2% year on year, and also some of the investment that we've put in towards some of those new offerings that Paula spoke about earlier. So in terms of benefits, so splitting out here between the platform, so Happy and Seb, and then the consultancy business, you can see there in terms of Happy SaaS subscriptions, 6.9 million at the end of June, so 10% increase on the same period last year. We also get some external revenue from commission from third-party suppliers that sit on the platform. So, for instance, cycle to work schemes, and collectively revenue there up 6% year on year at 4 million. And then whilst it doesn't contribute to the bottom line, I think we always like to point out the savings that the employees have made through using discounted vouchers through the platform. So 29 million of spend through the platform in the first half, 1.3 million of savings. Obviously is a really strong message for us, being able to reinforce to clients how much it's helping their employees with cost of living. And then I think Enecto, Paul already spoke about, so they've had a good first half of the year, particularly when you consider that last year they had a significant client win in the first half. That hasn't been repeated, but also some really good wins towards the end of the period that's giving us confidence in the second half delivery of their numbers. And then just in terms of balance sheet strength, I mean, this is really a reminder for those who were on last time. We underwrite the insurance products. So as a result, we have to hold a certain amount of regulatory capital, broadly 10 million at the moment, which is roughly double the absolute minimum that we would have to hold, but we're comfortable at that level. And obviously the requirement for that will grow as the insurance business grows in line with the strategy over the next few years. We've obviously got the opportunity to invest organically in any of the other products or channels that we're looking to develop over the next few years. And then in terms of return to shareholders, we've already spoken about the change in dividend policy that has enabled us to start to increase some of the returns back there. And that still leaves us opportunity if something comes along to look at M&A to supplement the growth. You can see on the right hand side there some of the criteria that we would be considering. So I'll hand back to Paula just to summarise and then we'll come back and answer the questions.
Okay, so I think, as you can see, we're in a super strong position for the year. I mean, it's a pleasure to run a business, with this level of predictability, and it's better now for the hard work we've put in, particularly in the last 2 years. But the focus for Sarah and me is very largely on making sure we can accelerate into the growth in every way that we can, knowing the confidence in the year ahead. So, my to-do list is as follows, I think, for the rest of the year. Insurance, the key thing here is converting that pipeline of new customers. How many more clients that we've got on the wings can we get the signature on at client level, so we can start with face-to-face. How many of those that we've got signed up can we start testing face-to-face at the end of the year when we're sure we're securing the year in hand, because it always takes a little bit of time to get up and running with new clients. The penetration, I think you can see, is well underway. The team have got that in hand. And then we will continue to prove out the digital offerings, but certainly in terms of effort, not at the expense of the converting the pipeline and the new customers. So, that's the key thing for us on insurance. That's the key thing that drives the growth for the 5 years. We are wholly focused on, the quicker we can tap into that growth, the better. And then on the benefit side, again, there's more to do on driving the adoption of our existing base. Every little helps on all of that. But the key again is the pipeline of new partners live, and particularly unlocking the opportunities that we've got with Sage. So it's not an extensive to-do list, and I think that's a great thing. And it's a great thing about the strategy that there are a few big things that drive the new revenue opportunities, knowing that really kind of at least 2/3 of the trajectory going forward for the 5-year strategy is insurance, and a lot of that is obviously recurring revenue, and clearly we have even higher recurring levels of recurring revenue in the benefit space as well. So lots of confidence in the strategy, lots of confidence in the years ahead, just keenness really to see what we can do to land that new business quickly. And again, I think, as Sarah said, there's some appetite really just to close out analysis maybe on M&A. We'll do a bit more for the end of the year, but the plan is driving an organic trajectory, and that's what we just need to make sure we are wholly focused on. Okay, and then finally, I think last slide, just to repeat the things that are just brilliant about this business. Again, really proud to be here talking about double-digit growth in every area of the business. We continue to generate high levels of cash. We are increasingly relevant, more relevant, I think, every time we talk to our audience about how our products and services support the market backdrop. The strategy is clear. We are already pressing into the growth opportunities for the strategy. We remain confident of the trajectory, which is wholly built on an organic plan. And, momentum clearly is already building, as you can see through some of our new wins and partnerships, against a backdrop of our continued really strong performance. Okay, I think we'll open up to questions. Sarah's taken a couple of these already. I can't remember if you've answered. There was a question about what happens if an employee leaves their employer. I was probably too busy reading the questions you've taken.
I did answer that one in terms of so we've got to keep my cover in place. For a good proportion of the book now, should they move on. There's one here on digital insurance margins and how digital insurance margins compare with face-to-face. What percentage of insurance income do you see this growing to? In terms of the margin, the honest answer at this point is we don't know, because we don't know what the claims ratios will look like in comparison to our existing ones. We obviously haven't got quite as much cost in terms of there's no face-to-face aspect to selling it, which is obviously quite costly for us. But our starting point as we test it is to price it similar way to our face-to-face product and sort of learn as we go from that. And in terms of in our strategy, we've basically said, I think Paula said earlier, 10% of our EBITDA by 2030 to come from new insurance products or channels, of which this will be one element.
Yeah. Okay. Maybe just give it another minute for any more questions. I think we're very conscious that this call attracts the kind of retail base of investors. We'll probably like to finish by saying a big thank you to everyone that's helped us navigate that community, particularly the Mellow Mondays and the Mellow presentations, of which we hope to be back in November. So we're grateful for the support there. All right, I think we're done. There are no more questions. So I've already stolen my wrapping thunder from this slide, but I think just to reiterate, this is a business with strong recurring revenues. The recurring revenues continue to grow. In the first half of the year, the business we signed, over 90% of that was recurring revenue. And we're certainly not complacent about that recurring revenue driving the entirety of the strategy ahead. There's new business to win, You know, we are ahead of the plan. We are working hard to land as much as we can quickly. We've got some great contracts and opportunities on paper that we are working fast to convert, and we remain super confident for the year ahead and the years to come. So thank you very much. I'll hand over to Alessandro to wrap it all up.
That's great. Well, thank you both for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. On behalf of the management team of Personal Group Holdings PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.
Bye.